Shannon, the author of Technical Analysis Using Multiple Timeframes, and he'll be talking about anchored VWAPs, his classic technical indicator that's his specialty. So without further ado, we'll go ahead and get started. And let me switch back over to this screen right here. So let me now join here. And here we've got Brian. Thanks again for joining us, Brian. We're really looking forward to this presentation. Anchored VWAPs, as I told you beforehand, is something that I would love to learn more about. It seems like a great combination of time, price, and volume and all of that. So yeah, thanks so much for joining us.
Audience with people overseas. I saw one guy saying he's going to be watching at 3 a.m. right now.
Right.
But also the speakers, you've got a nice, different, because there's different ways to make money.
Google Five.
Okay.
Right.
No one way is right for everyone. We all agree that William O'Neill is the number one, where we all kind of learn from and trickle down and then take the information and make it your own. That's what I think is the key here. What I want to share today isn't just volume weighted average price. I'm a swing trader, and I wanted to let people kind of understand how I swing trade and what that really means for me, how I engage in the market. So if you follow me on Twitter, last Friday I had put this chart of Casper mattresses on, saying, it looks good if it can take out yesterday's high, which was about $10 per share, then it looks good with a stop. And, every trade has to have a stop. For me, again, I'm a swing trader, so I put my stops pretty tight. 3 days later, the stock was up 21.3%. It doesn't always work like this. But I will tell you, what I do here isn't just what you see on the chart that I show you. Behind the scenes, what you don't see are some of the other things I'm looking at to make my analysis decision. So for instance, on a daily time frame, I want to see the stock above the rising 20 and 50-day moving average. The 20 is this light blue one right here. And you can see that, the 20-day crossed above the 50-day, and the 50-day was rising at this point as well. The other thing we have here is the volume weighted average price anchored from the IPO. So that's the daily time frame. And what we see also is the volume pattern. Classic what we're looking for, expansion on big volume followed by lighter volume consolidations as it absorbs those gains. So we saw the same thing right here. This was where I put the stock on and purchased it as well, stop being under here. And then, looking under the radar, not under the radar, but under the microscope a little bit at the 30-minute time frame. So each one of these candles represents 30 minutes. So we get a little bit more detail. We can kind of see what's going on within this consolidating flag. And, the way I looked for it is I always, one of my favorite swing trade tools, I absolutely will not enter a stock if it has a declining 5-day moving average. I want to see that 5-day moving average flattened to turning higher and then make a higher high above that flat to rising 5-day moving average. My specialty is really nailing the entries. That's what I do. And I get in, when I get in heavy, and I almost immediately sell some. For instance, in this one, I sold some up in this area. And, it looks like, we've got a nice trade. It closed out strong on Wednesday. But then what happened? Well, I said, this is what I said to Alpha Trend subscribers as well. Let's have 2 stops on this. We don't want to let this big run move. So here's the move from $10. We took a third off, and then it rallied. At the end of the day here, I said, we're going to have, I'm putting half of my stop underneath this little higher low and the other half under here. Now, I did not expect this to happen at all. In fact, what happened, bought the stock at $10 a share. I got out with a gain of $1.14 and $1.40 and $1.14. And then it just completely caved in. And if you're still holding it 1 week later, you're actually down. And, it's just the most foolish thing I can think of, to let an immediate 21%, gain turn into a loser in a period of a couple days. Winners don't take care of themselves. That phrase is something that somehow got popular, but it's work. You have to set your stops. You have to say, okay, now I'm in this. How much do I want to give back? I've already taken a third off because, again, I like to get in heavy. I think my timing is right on the entry. I have an initial protective stop. If the stock doesn't move immediately, I'll often sell part of it, try to get it down to a more normal type of size position. But I'm looking to take that first piece off into strength, simply that I'm now dealing from a position of strength. So if I sell a little bit here and my original stop was down here, then I'm going to raise my, as it breaks higher here, I'm going to raise my stop underneath this level, effectively taking all the risk out of the trade. And then it becomes managed risk. And, so Casper, it fell apart. It was a great trade, and that's all it was, is a trade, and that's what I do. I swing trade. So here's what we're going to cover today, and I've got a lot of information, so I'm going to go at a pretty quick clip. When the recording is available, slow it down so you can hear me talk like this and see what's on the screen. But for now, here's what we're talking about. Market structure. So there's 4 little sections: market structure, time frame and tools, strategy, which is trend alignment, and then the most important part, risk management. So let's talk about market structure. This is why we need to understand market structure. We've all seen one or more iterations of this chart, which is, it just shows a chart. And this was actually Cisco Systems. I put this together that long ago. This was Cisco in 2008 and 9, 10, 11. And, these are the same emotions that are repeated over and over again. And not just in this case, we see weekly candles, but it's also repeated on whatever time frame you're engaged in. If you're, day trading the futures off of a 1-minute chart or 500 tick or whatever you're looking at, believe me, these same emotions are going to be happening in here. The same emotions are what drove this stock to fall apart. We had complete greed. Did anything change with Casper? I didn't read the news. I mean, I don't care. I manage my risk, get out and move on, but I'm not going to allow myself to get stuck in, hey, well, it's back to where I bought it. Maybe I'll buy back some more and play these silly games that we play. Instead, what we want to do is we want to look at the market structurally and look at it. And I just posted the other day, the godfather of, the 4 stages is Stan Weinstein, which was a great interview. If you haven't heard that, check my Twitter feed. Anyways, he kind of, popularized these stages. They've been around, prior to him, but he really outlined it in terms of stage 1 is accumulation, stage 2 is markup, stage 3 distribution, and stage 4 decline. Now, what I've done is just taken it and breaking it down into little subsectors and use multiple time frames. That's what I'm looking to do. So when we look at this uptrend, we can't just buy anywhere. Like, who's the fool who buys up here and then it drops 10, 15%? You want to ask yourself, where has it come from? Where does it have the potential to go? So we take a cut, a section of that, and we look at it on a shorter term time frame. So this might represent 1 week, and here we can see that the stock rallied, it then went sideways and pulled back. Well, I never want to buy, even in a stage 2 uptrend on the daily time frame, I don't buy pullbacks. To me, I think it's one of the other foolish things that people say: buy the dip. No, don't buy the dip. Buy after the dip. Once it's gone sideways for a little bit of time, and then the momentum comes back in, we want to buy right there. I don't want to buy the breakout either, because I'm often going to be late. I want to buy when the buyers regain control and see that momentum coming back in. As I pointed out with Casper, when it breaks out right here, I generally want to sell some, because, who's the guy who buys at $11? Thank God they're there, because I was able to get more out of it. But when the stock goes from 10 to 11, it goes 10% in just a few hours, I'm not going to be a buyer there. I want to generally tighten my stops at those points and look to sell to those breakout buyers. So in other words, we want to anticipate what the crowd is doing, peel some off. There's a phrase that goes, sell some when you can, not when you have to. So you don't want to be, emotionally puking your position out. So we want these trends to be aligned. What we look for in stage 1 is accumulation, is we start to anticipate where the long might be setting up. Now, if you break the stage one into three separate sections, and I've got a kind of mathematical way of doing that, we want to focus on late stage one if we're going to anticipate that the buyers can regain control and we have a new momentum campaign underway that brings it into a stage two uptrend. So we're anticipating, we're creating a plan, we're saying, here's how I'd ideally like this stock to work. Now, the market doesn't care about my plan, but I want to be prepared for anything. I want to say if it breaks above X, I want to buy it with my initial risk at Y, and we'll see where the stock takes me. I'm not really big on price targets. I look for, maybe a prior level of resistance or a prior high to be tested. But if it's truly breaking out to a new, into a stage two uptrend, what I really want to see is that we make higher highs and continue to make higher lows. So in that stage two uptrend, that's where we participate. We've made our plan. We're not looking at it and saying, hey, what was up big yesterday? I want to get involved in that. We're going to look at it. And the way I do that is, let's say, again, we go back to Casper. If I want to buy Casper above $10 a share, I don't want to set my alert at $10 because oftentimes you'll see as soon as it ticks through $10, boom, it's at $10.30 by the time you go and pull up your chart and look at it. So instead, I set my alert at maybe $9.90. And then if that alert triggers, well, then I'll go in and I'll reset the alert for $9.95. And I'll keep it front and center. I'll put it in a level 2 screen. I'll put it in one of my more, close to my face charts so I can really start to look at it. I'll monitor the level 2. Is the speed of the tape picking up? So again, I'm looking at the very short term as well to really get my timing as precise as I can. I think if you're in it at the right time, right from the beginning, it puts you in an amazing position of strength versus being the fools. And sorry if that's you. That's the way I look at it, is just blindly buying pullbacks. We look at levels of interest as where the buyers may start to gain control. And I want to look at the shorter term time frame to see that there's actually evidence they do. So I participate when we have a stage 2 uptrend. I'm definitely going to avoid shorting it. And as the stock rallies, it might start to turn sideways. It undergoes some distribution. I'm probably going to get stopped out of that trade. And if I'm looking to short a stock, well, then I might anticipate the stage 4 decline and set up a scenario for that. And then in the stage 4, I'm definitely not going to be buying it. I'm not buying pullbacks. I'm not buying these growth stocks that, we just saw recently. A lot of these growth stocks were getting hit 50, 60, 70%. And the most annoying part is that a lot of people aren't going to learn the proper lesson because a lot of them came running right back. This market that we're in right now has so much liquidity that there's a lot of bad habits, I think, are being formed by people who are buying the dip and being rewarded for it, because that's not always going to be the case. So risk management, please make that your primary focus. You want to anticipate during, longs during the accumulation, participate, exit in stage 3, and just avoid the long for a stage 4 downtrend. So here's how it looks with a chart. We're anticipating, and what we look for is the short-term moving averages cross above the intermediate and longer term. They all start to turn higher, and these pullbacks to moving averages, some people buy them. I look at it as, here's a level of interest. Let me zoom in on a shorter term time frame and find that precise place to purchase. Stage 3 distribution, moving averages cross back and forth. What do moving average crossovers represent? They represent indecision. It means the shorter term trend that you're looking at crossed below the intermediate term trend. People always say, are you bullish or bearish? Well, depends on the time frame. We're in a major uptrend, but if we start pulling back 3 days in a row, I'm looking at saying, well, we're in a bearish environment. We're making lower highs and lower lows below a declining 5-day moving average. I'm not interested in buying until this resolves itself. So as the market, the stock, whatever it is you're looking at, Bitcoin makes a lower high and lower low, you avoid that on the long side. Or you can make money buying stocks in downtrends, but think about the definition of trend, a downtrend, lower highs and lower lows. The way that that's established is only one way. It means that the declines might be $5 and we rally $4. We decline $6 and rally $3. We decline $8 and rally $3. the sum of the declines is going to be greater than the sum of the rallies. Therefore, there's just mathematically more opportunity on the short side. And the old phrase, news and surprises tend to follow the trend. That's why you see bad news comes out at bottoms and good news comes out at the tops. The market is a discounting mechanism. It doesn't care about what happened. That's in the past. It's trying to look forward and saying, here's what's coming down the road. So for swing trading, which again is my preferred time frame, it's not the time frame for everyone. And some people's definition of swing trade might be different than mine as well. You have to keep that in mind. The way I look at it is it could be a day trade. If I'm wrong, if I get stopped out right away, then it's generally a day trade. A lot of times I will day trade that first initial third of my position if I get a strong response and the stock rallies quickly. And again, it's simply a risk mitigation tool. The way I get into trades, I don't mind sacrificing that first third, because when I have a high confidence trade, if I feel I'm involved at the correct time, then I get in extra heavy, knowing that I'm going to sacrifice that first piece very quickly, and it might continue to go up much higher. And it doesn't bother me to sell that. It's simply a risk mitigation tool. So I can say, if my stop was 40 cents away, let's say my stock was 60 cents away, and now I take a third of my position off with a 30-cent gain. Well, now I've reduced my risk by 10 cents on the balance, because I've taken, 1/3 of that piece off. So the goal, with swing trading, of course, is to be in the stocks that are moving. These are the ways that, Leaf and Oliver have won the, trading championships. They're leveraging time, and that's the goal with timing, is to leverage time so that we don't have to sit around and bullshit ourselves about, hey, it's a good company, it'll come back. Just wait, wait till this conference or wait for that earnings report. I'm a believer, I'm a hodler, whatever it is. If it's in a downtrend, avoid it on the long side. Stocks can either go up, down, or sideways. So we're looking typically at a breakout, a continuation, or a reversal. And the key is to keep it really just that simple. The goal for me in swing trading is to participate in the continuation of of an established trend. So for me, it's, again, maybe a couple days, generally, no more than about 3 weeks. And I don't look at the market and say, hey, I want to hold this long or I want to hold that long. Instead, it's up to the market to tell me. If I buy as the stock makes a higher high above the flat to rising 5-day moving average, I'm going to raise, as it makes this new high, I'm raising my stop up under here. As it rallies and breaks this little peak, I'm going to raise my stops up under here. As it breaks that high, maybe I got out here or here, but I'm definitely not going to hold while it's making lower highs and lower lows below a declining 5-day moving average. Instead, I'm going to say, I want to be a buyer over here, because I might think, hey, well, it's on the 20-day moving average on the daily time frame. That's a level of interest, but we only want to buy if it's back above the flat to rising 5-day moving average, and buying over here. Instead, waiting for it to establish way down here, because we don't know which one of these is the lows, and it's only ego satisfying to hit that. And once in a while you get them. Most of the time you don't. Trust me, I wasted a lot of time in the market. I've been doing this full time since 1991, 30 years. I wasted a lot of early years buying stocks that I thought were good companies and trying to pick the low and then puking them out right at the bottom before they do rally. So I personally look for at least 500,000 shares a day. And I look at, a lot of places look at the average of the last 50 days. For me, it's the last 20 days. So the 50-day moving average of volume might be 385,000 shares, but the 20-day could be 612,000. So I like to say, what's going on within my time frame? So the last 4 weeks. That's what's most important, because that's what's most likely to hold over and continue, rather than something that was 50 days ago. So I look at, people say, what's the most important time frame? I guess I would say, the 30 or 60, 65 or 15 minute, but I would say I look at all the time frames. Sometimes I look at a monthly chart. A lot of times I always have a week. I always am aware of the weekly time frame. I'm always, so on my screen, I have a weekly chart up top. I have a daily, a 65-minute, a 30-minute, 15-minute, and I even have a 2-minute time frame way over on the side, so that as soon as I populate a trade, a symbol, it all populates into all those time frames, and then I have the full complete picture. I can see where the trends are aligned, so I don't get faked out buying something, getting excited as I see it's rallying right up to the declining 5-day moving average. I'm just not going to buy that stock. I generally, position sizing, I hate to give advice there because it's different for everyone. If you're brand new at trading, you should have 1/10 of 1% of your account into a stock. If you're really swinging for the fences and you're experienced, 30-40%. I know people who do that. One of the easiest ways to identify the trend, if you're having a trouble, just looking at price action, is a dominant moving average. You start out with one moving average per time frame, and that allows you to say really quickly who's in control, the buyers or sellers. We want to look at a couple things. What's the slope of the moving average? If it's rising, for me, like a 50-day moving average, if it's rising, I look at that stock and say it's innocent till proven guilty. It doesn't mean I'm going to blindly buy it, but it says here's a trending stock. It becomes a candidate for study on shorter term time frames. But if it's extended 20% away from it, I want to see a pullback. I don't want to just buy strength. So the question is how far above or below. And if you look at a 50-day moving average, and I think this is important, that a lot of people don't talk about the psychology of what's going on at that 50-day moving average or that 20-day moving average or the 200. Why do we use these moving averages? Why do you use a 50-day moving average? Have you ever asked yourself that question? Because everybody else does is really what the honest answer is. If we were really being, intellectual and correct about the way the market works, we would actually use a 63-day moving average, because there's 252 days a year in trading in the market. If we divide that by 4, that's 63. Why would we want to divide it by 4? We would want to divide it by 4 because that's how our calendar works, that the companies report their earnings once per quarter, once every 63 market days. Anyways, we don't, that's not the dominant moving average that everyone looks at. So instead we look at what everyone else looks at, the 50-day moving average. Why does the pullback to the 50-day moving average tend to act as support? Well, let's say you're an institution with 5 million shares. You start seeing the stock rally, you're going to maybe, sell some, maybe you sold 500,000 shares into that rally. And say, hey, if it pulls back down to the 50-day moving average, we'll buy back 200,000. We'll stick a bid in there at that 50-day moving average so that other people see that bid and they say, hey, look, it's working. There's support at the 50-day moving average. What if you were an aggressive hedge fund and you started shorting, saying, hey, this is overbought, our indicators say this and that. There's always shorts in the market. Don't think that there's not. As it pulls, so they might say, hey, we're going to short it here and we're going to, buy it back. We're going to cover at the 50-day moving average. So what do we have? We have less supply. They're not shorting. We have more demand. They're starting to cover that short. What about the institution that was selling on the way up? He was offering supply, now demand. And then everyone who's been trained, the 50-day moving average typically acts as support. So what do people do? They scan for stocks touching their 50-day moving average and they stick bids in. It becomes a self-fulfilling or self-reinforcing at a minimum prophecy. So, when the 50-day moving average is declining, it tends to offer resistance. When we see it moving back and forth above and below, indecision. Pull back to the 50, rock and roll. That's why we want to look at it. So if you're going to use just one time frame, one moving average, on a weekly time frame, I would say look at the 40-week. That's approximately equal to the 200-day moving average. And look at, on a daily time frame, the 50-day moving average. That's approximately the 10-week moving average. And I say approximately because if you think about a weekly chart, and if you're looking at the average of the last 10 weeks, on a Monday, you're actually looking at 9 weeks plus today. So you're only looking at 45 days plus today, 46. So it's not truly a 50-day moving average on that weekly chart. Plus, there might have been a holiday that was a half a day. So if you want to keep it, intellectually honest, that's the way you do it. And that's one of my big things with the intraday time frame. And that would be, looking at anywhere from the last 10 to 50 days. My main one, as I already mentioned, is the 5-day moving average. We'll talk about the math of that. I'm not talking about a 5-period moving average. So some people will look at a chart, they'll look at the 30-minute time frame, and they'll say, Brian, I put a 5 moving average on there. Why is it following so closely? It doesn't look like yours. Because you're looking at the average of the last 5 30-minute candles, not a 5-day moving average. Intraday, I love using the daily volume weighted average price, the 2-day volume weighted average price, the 3-day often, just because you see those levels defended over and over again. We're not going to get into the nitty gritty of that here today because there's simply not enough time. But, for swing trading, I like to see at least a 20 and 50-day moving average on the daily time frame. On an intermediate term, I'm going to look at the 5-day moving average, maybe even a 10-day moving average. And then shorter term time frames, I'll look at volume weighted average price levels, VWAP from a swing high or low. So this was Tesla, I guess about a week ago. And I put this on Twitter just kind of as an educational thing, because again, people ask me all the time, Brian, I put a 5 on my, chart and it looks like this. Well, that's because you're using the average of the last 5 periods, not 5 days. So if you think about what a day is, the market is open from 9:30 a.m. to 4 p.m. Eastern. That's 6.5 hours, 6.5 hours. In the course of 6.5 hours, 60 times 6 is 360. Plus that 30-minute period, there's 390 minutes per day in trading. So over 5 days, 390 times 5 means there's 1,950 minutes in a day. So if I want a true 5-day moving average, not something that started 4 days ago plus today on a daily time frame, but on this one, for instance, I'm looking at a 30-minute chart. So if the time frame is 30 minutes, well, 30 times what, or 30 divided into 1950 equals 65. 65 periods. So this is a 65 period moving average. Now, when it's below that declining 5-day moving average, I consider it guilty till proven innocent. I'm not going to buy these little pops above it. I'm not going to try to buy the lows. But as it starts to turn sideways, and then we see what? Well, we see this is clearly a stage 4 decline on a 30-minute time frame. Here's a stage 1 accumulation. Boom, what happens right here? We have a higher high above a flat to rising 5-day moving average. We can get long there with a stop under here and see what the stock tells us we can do from there. Now, the problem with Tesla is that the bigger trend, we've still got a declining 20 and 50-day moving average. But the point is, why do I use a 65-minute time frame also instead of a 60 or 1 hour like most people do? If you look at a 60-minute chart, a 1 hour chart, what you're actually looking at when you populate your chart is you're looking at one candle that is from 9:30 to 10 a.m. Eastern, and that candle closes. A new candle begins and shows you from 10 to 11, 11 to 12, 12 to 1, etc. So what you're looking at are 6 60-minute candles plus 1 30-minute candle. So what you're in essence doing is saying that the first half hour of the day is twice as important as the next 6 hours of the day, which it isn't. So to keep it honest, you want to either use anything that's divisible divided into 1950 for that purpose. So when we look at a swing trade, what we want to do is we want to say, what's the trend on a longer term time frame? Well, here we have a stock with a rising 50-day moving average. We see some nice volume bumps with later volume on these pullbacks and consolidations. So again, I don't want to buy this breakout or this breakout. I want to look to the shorter term time frame. And when it makes the higher high above that flat to rising 5-day moving average, that's where I get involved. And a lot of people say, well, do you wait for volume? No, because where does volume usually peak? It tends to peak at turning points. So what we want to see is the volume pattern expanding as the stock rises, and lighter volume consolidation says, pullbacks and consolidation say there's not as much aggressive supply coming into this stock. It's lighter volume. So it tells us it's more likely to continue than reverse. A trend once established is more likely to continue than reverse. So I get involved here and I don't know what's coming. Nobody knows what's coming. I love it when people tweet, here's what this stock is going to do. I mute those people. I block those people. Nobody knows. Get rid of will do and is going to, because nobody knows. And that's why you buy that, but you also know where's your stop. For me, it's pretty aggressive. I'm not waiting for this low to be violated. I want to say for my stop, it's below the most recent relevant higher low for my time frame, which would be right here. Then our job is to manage risk. Keep raising those stops. As the stock hits this high right here, we raise our stop there. As it takes out that high, we raise our stop under here. If it goes and takes out this high right here, I would raise my stop. If instead it goes like this, that's where I'm out. The pattern of higher highs and higher lows is no longer valid. So why would I want to hold the stock if I call myself a swing trader? It doesn't make any sense. On the downside, it's just the opposite. We look at a stock in a downtrend. We've got a declining 50-day moving average. To me, it's guilty till proven innocent. It's not a good company. It's not on sale. It's being sold by institutions who control the market. It's guilty till proven innocent. So we look at this and say, okay, what's going on in here? It's starting to turn sideways. It's at this level of interest, the declining 50-day moving average. A lot of people, a lot of uneducated, uninformed people get long in here because they say, hey, it's above the 50-day moving average. But what's the direction of the 50-day moving average? It's lower. It's guilty till proven innocent. So I want to look at that stock and say, okay, here we saw a stage 2 uptrend on the shorter term time frame. Then we saw it start to turn sideways in here. And as it breaks the low of that, it makes a lower low below a flat declining 5-day moving average. That's this purple one, or blue, whatever that color is. So that's where you want to short and put your stop above the most recent relevant lower high. And then our job is simply this. As it makes a new low here, we lower our stop to this point. As it breaks this low, we lower our stop here. As it breaks this low, we can lower our stop to this point. And try to repeat that over and over again and be as disciplined as we can hopefully become. So again, it wasn't meant to be just a volume weighted average price presentation here today, but this is what I've been the champion. I've been the champion for the volume weighted average price. I've gotten it included in over a half dozen softwares that wouldn't have it without my efforts here in the last decade, basically. The volume weighted average price, pronounced VWAP as an A as an apple, not O as an opportunity, is comprised of three things. Price, only price pays. That's the only reason we're doing this. We're not doing it to show off our impression, our friends. Hey, look at the volume. Great. How much money did you make at analyzing volume? It's a tool. It helps us. It's useful. It's very useful. Don't get me wrong. It shows us the emotional intensity level commitment of the buyers and sellers. Why do stocks go higher? Because there's not more buyers than sellers. There's more buyers at a certain price, so price discovery allows it to move higher and find where the supply is willing to offer. There's more aggressive buyers than sellers, so they'll start chasing it higher. It shows the emotional intensity level. Time is subjective, but these are the components of the volume weighted average price, the three most important things in the market: price, volume, and time. I will argue to my deathbed with anyone who says anything is more important than those three components in the market. The way that I just explained this on Yahoo Finance yesterday, the way to think about the volume weighted average price is to think about dollar cost average. If you buy $1,000 worth of stock of Apple for this period, this was about a year ago I put this together. At that time, the price was $199. So if you bought 1,000 shares, $1,000 worth, you would have bought 5.02 shares. On the 15th of the next month, the stock dropped about 10%. So it dropped to 192. So you bought 5.24 shares instead of 5. So you're buying more at the lower price. At this point, your dollar cost average is 195.08. And that repeats up until the stock rallies to 235, and your $1,000 only gets you 4.25 shares. So at the end of these 7 purchases, your dollar cost average is 206.60. We know that because we add up these 7 purchases, divide it by the price, and we now have, if we take how many shares we have, this is our volume weighted average price that we paid, because the dollar amount is a constant, but the volume is what is the variable in here based on the price. So the volume weighted average price is simply a dollar cost average. And the way we want to look at it is the way we want to look at really any simple moving average, which is, look at the direction of the volume weighted average price, whether it's, and what you'll see is a rising volume weighted average price will often act as support. In fact, often it'll be the exact precise turning point. It blows my mind every single day. At some point, I look at it and say, one of these days, I'm just going to buy because it's at VWAP, but that's not my discipline. My discipline is, okay, it's at that volume weighted average price. That's a level of interest. Now let me study it on a shorter term time frame and see if in fact the buyers are gaining control. And if they are gaining control, I want to participate, but I also want to know, where does my stop go in case it turns back around? Because nothing is certain in the market, and we always have to have that risk. So be aware of the direction of the volume weighted average price. The steeper it is, and when we see sharp pullbacks to that steep volume weighted average price, it's often a quick bounce for that. I put this on last night. I was looking at crypto and, Bitcoin. This was, that's probably about 14 hours ago right now. But I said it's approaching. So this is, I should have captured the whole chart, unfortunately. So this was the recent low at about 31,000, I think, whatever that recent low in crypto was, Bitcoin. And I don't have my glasses up. So these are 2 hours. So it rallied up, and I said, here's a level of interest in Bitcoin. Personally, I'm not very interested, meaning I wasn't going to be a buyer there. But, this morning I woke up and looked at it, and you can't make that shit up. It nailed it almost to a T. If you're not using volume weighted average price, you are really missing a big valuable piece. It bounced from 35 to 36. There's a great scalping opportunity if that's your time frame. It's still in a longer term decline, but yeah, it works in crypto. So when I talk about a volume weighted average price pinch, what does that mean? Well, again, what's the trend on a stock? Well, if you look at the longer term time frame, you see that on this stock, the buyers are in control. And we know that because it's making higher highs and higher lows. It experienced a large breakdown here and broke that pattern. So, I would have said, we have now a lower high and we broke this low. Where's the potential for support? Well, we take an average price from the most recent swing low, and you can see how that was defended. To me, that tells me, okay, let's see how we are now. So the buyers are in control. The sellers, have been losing. But on the shorter term time frame, if we just take a look at this point forward and we say, well, from that peak, once it breaks that lower low, we know that's an important peak. So we put a new volume weighted average price on that. And you can see it held as resistance. So when we combine these and put the two of them together, we see this convergence in here. And all this is, to me, is it's saying the convergence of supply and demand are meeting in the middle. The longer term trend on this stock is higher, so it's most likely going to continue to move higher. So when I see a stock in a volume weighted average price pinch like this, it says the average short from here is now at this price. The average seller sold at this price. The average buyer from here is now, maintaining control. So if we're to get back above this level, it tells me the buyers are in control. The average short is now losing money. Doesn't mean all of them are, but the average short, if you've been dollar cost averaging down. But the average long who's been dollar cost averaging into this is now in control. It's innocent till proven guilty. So when it's in that pinch, it becomes an opportunity to watch. Here's one that I put in January on Apple. Same thing. This was a tweet that I grabbed. It was holding the volume weighted average price from the prior low, and then it made a significant pullback. So I put a volume weighted average price on that high. And I said, let's see some further tightening. Maybe it can get out of here. And it did. So we anticipate during this compression of energy, and we participate here as it breaks higher and the buyers regain control. This is one that I put on Twitter as well. I traded a grade. It was Coursera, CRSR. It was an IPO. Initially, the IPO, it fell below it, but the buyers quickly gained control. It rallied up. It made an important pullback. So I put a volume weighted average price off of that. And I was showing this, on Twitter saying, here's where I want to be involved. It gapped up that day. I bought it over in here. And then from there, the stock went, I don't know, 300% or so. I didn't hold it for 300%. Trust me. I think I, got it for 30, 35%. It was a really nice trade. That's my time frame. After, if they continue to go higher, that's fine. I look to repeat over and over and get back in. Now, the reason we don't just buy in a pinch, here's another, Coursera came public. It looked like they were starting to find some buyers in here, and this was being defended. So I'm anticipating something like this to happen. And then as it gets above that volume weighted average price and makes the higher high, I'm going to either put my stop under this low or this low, but instead the stock breaks down. Big deal. So what? Move on to the next. So what we're looking at, the point I'm getting to here, the strategy is trend alignment. And what, it's based on Dow theory. What slide am I on? I think we're doing good time-wise. But Dow theory, there's three trends in any market. It's not just an uptrend because there's secondary waves and there's tertiary movements, the little ripples that Charles Dow called insignificant. That's my timeline. That's where I go. So what we're looking for is things to line up perfectly across multiple time frames. So the way I do that for swing trading is you want to start out with a minimum look of at least the daily time frame. And on a daily time frame, anywhere from 150 to 200 days is generally what I keep on my chart without getting them too smushed together where you can't see the candles anymore. If I need more than that, I go to the weekly time frame. If I need more than that, I go to a monthly time frame. It's not just one time frame. On an intermediate term time frame, again, I'm using multiples of 30 minutes or 15 minutes or something divided into 1950. So at a 65-minute chart, there are 6 of those per day. There are 13 30-minute periods per day. And there are how many 130-minute periods per day? There are 3. 3 times 130 is 390. There's 390 minutes in a day. So if I want to look intraday, let's say at the last month and a half, I might look at the 130-minute candles because I can still see the structure, see where those key battle zones, those key prior support and resistance levels are that I can use to start figuring out what's my plan going to be. I'm anticipating in here. I'm trying to figure out what's my risk reward. And again, I'm figuring out here's where I think the stock can go, but it doesn't mean that's my target. It's just something to intellectually say the risk, the perceived risk is perceived reward is worth the risk I'm willing to take based on where my stop is. And I say perceive because none of us knows what's going to happen. Anyone can say, hey, I've got a 50-to-1 risk reward on here. Well, that's because you made a ridiculous target. It's never going to happen. My price target on Bitcoin is $1 million. So buying at 50,000, it pulls back to 30 doesn't matter to me. It matters to me. And then shorter term timing, a 15-minute, a 10-minute, a 5-minute. I'll even go to a 1-minute time frame, particularly if gaps, and I'll show you an example of that with a stock I was just talking about on Twitter this past week. So what we want to do again is we want to anticipate. Don't be reactive. Don't be the people who chase these moves. I always get asked, Brian, what do you think about this stock? I look at it, it was up 10% in the last 3-4 days. I mean, consistently it happens. It could continue to move higher, but it's a little stretched here. Why not wait for it to, pull back in this zone, anticipate in here, and then participate? So we're just sitting on our board. We're, taking in the view. We're looking at what's going on. And then as the wave starts to crest, we start to paddle in, jump on, and ride the wave. And once we're on the wave, it doesn't mean, hey, this is good, we just aim our board straight in. No, we want to carve, we want to move back and forth with the wave, we want to manage risk because there's a reef ahead, look out for that shark, look at that little kid, I got to avoid him. Risk management when you're on that wave and protect your profits. Don't smash into the kid and rip his eyeball out. Don't go into the reef and cut your whole body out. So here's two stocks that are currently setting up in a pinch. I'm not buying these, but I have them on my radar. CVS back in April made an important low. It had this big rally, and you can see we just tested the volume weighted average price from that low this I think that was on Thursday. And as it started pulling back, I put a volume weighted average price here. And now you can see that that volume weighted average price almost to a T. I mean, it's crazy how it just touches in there. So what am I anticipating in CVS? If you're the type of person who wants to buy right here with a stop under here, that's fine. What I want to do is I want to see it do this. I want to see the range tighten up. And then as that 5-day moving average starts to rise and it gets back above that volume weighted average price, it tells me factually that the average person who bought in the during this pullback is now winning. The buyers are in control. The average short is losing money. What do you do when you lose money in your short? You cover. So I want to buy here and then set my stop underneath this low if that's where the low is. If instead the stock, let's say it does this. Let's say the stock goes like this on Monday. Let's say it goes like this. I would not buy it here because it's short-term extended. I would rather see it do this, test it, and then maybe buy it right here as it's rallying back up on a shorter-term time frame with a stop under here. Home Depot is another one. The low in March is just been tested on Thursday, but the buyers aren't in control. You can see that from this important peak where we pulled back from 345, the sellers are defending this level. So maybe this happens. That's not the trade I'm looking for. The trade I would be looking for is this one, and maybe it continues higher. And I want to be a buyer right here. I don't want to buy pullbacks. I want to buy after the pullback and the buyers have established control. Why play guessing games? Let the institutions who are building hundreds of thousands and millions of shares, they have to buy into these conditions. We don't. Let them do the dirty work. Let them leave their footprints and say, here's where it's going. And it doesn't mean it's going to be a winner. That's why we have a stop underneath one of these higher lows and say, that's where I'm going to get out. So, again, it's all about anticipation. It pulls back to the rising 50-day moving average. Some people buy there. I don't, because this is what it looks like on the shorter term time frame. So in there, I'm saying I'm studying this on the shorter term time frame. This is what the shorter term time frame looks like. The 5-day moving average flattens out. It makes the higher high above the flat to rising 5-day moving average. It tells me the pullback is most likely complete. The average participant from that peak is now in control. It's above the rising 5-day moving average. I want to participate, rise my stop up under these higher lows, and see what the market gives me. So before you get in any trade, it's always the same. What's your perceived risk reward? It's garbage in, garbage out. You can, again, say my price target is $1 million for Bitcoin, so a $20,000 pullback doesn't matter to me. I still have a bazillion to one risk reward. That's just foolish thinking. That's not real risk management. Use key levels based on the chart. It's okay to have a 5% stop or a 7% stop. It's better than no stop at all. But what you want to do, again, perceived risk reward, what is the definition of trend? Higher highs and higher lows. So if I buy a stock, here's one I just put on Twitter, what was this, June 8th, so whatever that was. Anyway, so I said, listen, VMware, here's a weekly chart on the inset, a 3-year base, basically. It's been as high as 220 over here, that weekly time frame. What do we see? Well, when we break it on a daily time frame, multiple time frame analysis, looking at a weekly chart and then the daily time frame, we can see that this prior resistance has been holding a support. We've got a rising 50-day moving average, the 20-day moving average flattened out, but it's still just kind of consolidating in here. So this was in the anticipatory phase. I said no position yet, close eye on it. It just reported earnings, it's absorbed that, and now what happens? So then here's exactly how I got involved in this trade. Here's the volume weighted average price from that peak being this one right here about a month and a half ago. And we can see that because, again, these are 65 minutes. So the 5-day moving average, here's my 30 period. We saw this trend line and it made the higher high right here. Well, it gapped up. I didn't buy that. I buy as it gets back above the flat to rising volume weighted average price on the 1 minute time frame. And then I will often say, I'm going to put half my stop below the low of the day and my other half will go under here. It rallied very quickly. I took a third off. And I'm still in this trade. And this is now a 15-minute time frame. Each one of these candles is 15 minutes. So this is the day of the entry at 160. I'm sorry, 162 and change. I forgot. I've got it written down. But here was the entry. That kind of gets swallowed up on the 15-minute chart. You can't see what's going on the 1 minute time frame. But now I've got two stops on this. I've taken a third off that first day, because I want to reduce my risk, because I got in aggressively. I got in with big size. It allowed me to, my initial stop was under here. And then as it broke this high, my stop went to this point. As it broke this high, I put the stop here. And on Friday, it made a higher high. So now what I'm going to do is I have two stops. I have a 2/3 position. Half my stop is right here and half my stop is under there. I want to give the second half a little bit of room because that's basically break even. If I get stopped out here, I make money on 2/3. Now I've got that final piece that, is it going to do this and stop me out? Or is it going to just continue to go higher highs and higher lows and achieve its potential that it shows us on the weekly time frame? This one I put on May 28th. Here's one to keep an eye on. It looks like it's poised to move out of this pennant. So what's a pennant? Well, we've got this big move up and then a tightening of this consolidation. It's above a rising 20 and 50-day moving average. They had good, strong earnings and revenues. Worst case stop, if it triggers, 2706. So did it ever trigger? Did it ever make a higher high above that flat to rising 5-day moving average? I don't have the 5-day moving average on here, but no. So there was no reason to enter. We anticipate, but we wait for price confirmation before we enter. The only time we wouldn't is if we're going to do a cheap buy. If you're going to do a cheap buy, you've got to be really disciplined about taking your stop. If that's your worst case stop, honor your stop, because as much as it sucks to lose 1.5 points, it's much worse to continue to hold it and make money as the stock continues to make lower highs and lower lows. The point is there was no reason to be involved. There was no reason for the loss. But had it triggered, you take your stop, your entry, you manage risk and listen to the message of the market. So risk management, we've got three forms of risk the way I see it. Most importantly, of course, is price, because only price pays. It's the only thing that pays. It's certainly the only thing that hurts you. If the stock rallies on light volume, be aware, but it's going to spend the same when you get to the bank. Time is our other risk. Are we tying our money up in stagnant stocks that are just a waste of time here? And then, of course, we know that leverage is the key enemy. You don't think so? Ask Bill Hwang, the guy who lost a $4 billion fortune being heavily concentrated in 6 stocks, refusing to take small losses and instead getting liquidated right at the shittiest prices you can by people savvier than he was. We've all seen this chart. It's amazing. When you lose 50% on a position, you need your stock to double to break even. If it goes down 80%, you need that stock to quadruple. Cut your losses under 10% at a minimum. Never allow these columns to get into your focus, I would say. Because, how often do you have 100% movers? Most likely, the only times a lot of people get 100% movers are the ones they held to break even, rather than selling a stock that's up 100%. That's the sad reality. So when we talk about risk management, plan your entry. Where's your initial protective stop? Do you have an idea where you might take that first piece off? Is there a prior level of resistance that might slow it down on the way up? What's the next level of interest above? Is it daily R2 if you're shorter term? Do you have a strategy for locking in profits? Again, the risk, the winners don't take care of themselves. What's what kind of share size do you do? What's the personality of the stock? That's a big one. I definitely, I don't like trading little biotech stocks. Sure, you see them every day on the top winners, up 100%, up 80%. Look at the losing stocks that day too. They're littered with stocks that are down 50, 60%, and most of them are biotechs. The risk reward is terrible in most of those. unless you know something, because I don't know anything about these companies. I'm looking at a chart saying it's a low volume pullback, it's a biotech, lower share size. What's the personality of the stock? There's no set, ways to do it over and over. And who has a favorite quote from a Federal Reserve chairman beside me? I don't know, maybe some of you do. But risk management is our job number one. Alan Greenspan, I remember I was watching TV one day when he was in his, not office, but is his office, as he was the chairman. He said, basically, I view my job as risk manager for the economy. Could you imagine managing that risk? You're going to get things wrong and they make a lot of mistakes, but you can't cut your losses as quickly as we can. So just remember, this is a tool, technical analysis. Things go wrong. You have to have a stop. Manage your risk. The way I view it is, number one, look at the daily time frame. What's the direction of the 50-day moving average? If it's rising, it's innocent till proven guilty. If it's declining, guilty till proven innocent. If it's rising, it's a candidate for a stage 2 uptrend. It's in an uptrend, so it's a candidate to buy. But if it's rallied 10% in the last 3 days, I'm not going to buy it. If it's instead, at a prior level that looks like resistance, I don't want to buy it. But if there's a good risk reward, so we want to look again. Here's our daily time frame, and on that daily time frame, we break it down to shorter term time frames and say, we know that this is a stage 2 uptrend because we've got higher highs and higher lows. On the shorter term time frame, though, we see this stage 3 distribution forming. So we're going to exit if we were previously long. And as it pulls back, I'm not buying dips. You guys go ahead, buy all the dips you want. I'm avoiding it. There's no reason to take that risk. But instead, on the shorter term time frame, what does that pullback look like? It looks like this. And then it starts to turn sideways. And then it makes that higher high above the flat to rising 5-day moving average. So as it makes that higher high, that's what I call the new stage 2 on the shorter term time frame. That's where I participate. I was anticipating in here as it's going sideways, participate here, and then what? Then manage risk. My initial stop goes under here, I raise my stop up, manage risk over and over again. That's all I have. I went long. Richard, I think you've got some time for questions, hopefully. Thanks for tuning in, everybody.
Brian, that was absolutely fantastic. Thanks so much for sharing your time and your expertise over your decades of trading. We've got time for a few questions, and definitely people have submitted some good ones. The first one that I saw that was interesting is, does it matter where within the base that VWAP pinch is happening? Like, is it below the bottom half of the base versus in the upper half of the base?
I would prefer just, generally, I want that range to be as tight as possible. I want them to really pinch. I want them to pinch like this. I don't want them to pinch like this.
Right.
I want it to be tight. The tighter it is, the more shares I can do, because I know my stop is, if my risk is, let's just say $1,000 and my risk is $1 away, well, I can do 1,000 shares. But if my risk is my stop is $3 away, I can only do 300 shares. I have 3 times less opportunity to make money, is the way I see it. Right. So I want that stop as tight as possible, and that occurs through, that pinch to occur nice and tight in there.
Makes sense. And are you always waiting for a stock to, are you always selling into weakness, or do you also sell some into strength?
I only sell into weakness when I'm wrong.
Right.
When I get stopped out. I always try to sell, especially that first third, into that strength. I might look at this stock and say it's 10, I think it's going to 15, but if it goes to 10.40, I'm selling a third. Boom. It's just what I do. Because again, my style is I get in very aggressively, because where I excel is nailing the entry point.
Right.
So I get in heavier than what most people would consider responsible. And I admit, when I have an A+ setup and I get involved with that big risk, I have the same doubts, fears that everybody else has. I don't know what's going to happen to that stock. And I've got an outsized piece on it. I'm going to watch it close, and it rallies quickly. Boom. Now I can breathe a little bit easier. I'm dealing from a position of strength. Now I might even have on the 2/3 balance, because I've taken that first third off, my risk on the rest might actually be break even at this point. I've theoretically taken the risk out of the trade.
Gotcha. And what does your daily and weekly routine look like to stay on top of the market as well as look for new positions?
Yeah, good question. So when it comes to scanning, I do it all manually.
Hmm.
As I mentioned, I've got 6 time frames on my screens, and usually on a Saturday, worst case Sunday, I'll go through my master list of stocks. My master list of stocks is about 900. I don't expect to trade those 900 stocks, but I do go through each and every one of them, and it's probably, at the pace of boom, boom, boom. Hey, there's something interesting. Write that down. I will then come up with a list that looks like this. That's a list that I'm going to look at. So I'll get it down to about 250, 300. Again, I'm not looking to trade those, but that's good for my next week. Those are, I've got all the FANGs in there. I've got some ETFs. I don't expect to trade everything, but what I've done is I've just looked at most of the very liquid stocks in the market. And I'll look at that list and say, wow, isn't that interesting? I've got more tech stocks this week
Right.
than I have previously. I have less oil stocks. In fact, the banks are looking weak. I didn't look at the banking sector, but I noticed all these banks are starting to be under their 5-day moving average. So it gives me that anticipatory look into the market.
Right.
With that list, what I do is I break it down and I put little check marks next to it. And that becomes my focus list for each day. So each day I have about 30, 35 stocks. Again, I'm not looking to trade them all, but I want to familiarize myself with the way they trade. So I'm always in anticipatory mode. I might add the stocks that had big moves, but I'm not going to look at them. I'm going to look at them, put them on my list, but wait for the pullback. I'm going to start to anticipate and realize that it might take a week for it to settle down. So what is possible in the next 2 to 3 days is what I'm looking at in these stocks. And I'm always looking at what's the direction of the 5-day moving average, where are we in relation to it, long or short. And I really don't trade short much. But then, of those 35 stocks, I might set alerts on 25 of them.
Right.
Just because I want to know when something's about to happen. 3 or 4 of those stocks, those are my focus core stocks. And I've got those front and center. I've got them up on a level 2 over here. I've got them each on a chart that has 2-minute bars for the last 3 days. So I can, and I set the alert, if those alerts go off, or I'm not, because I'm not paying attention to them as closely, because you can't watch everything, I get an alert. It's 1910. If it gets above that to where I want to buy, so I'll set my alert at 1905. I'm busy watching something else. I see that, I pull it up. I want to see volume starting to come into it. I want to look at the level 2. Is there a huge offer in the way? To start to get in that. Now it's time to really put my war paint on.
Right.
and get ready.
Right. Perfect. I think we'll call it there. But Brian, thank you so much for coming on and sharing your expertise. We really appreciate it.
Yeah.
And I'll